You have more facial hair.
Hey
Yes.
Greg, hey Sky, how are you?
Good morning.
Morning. How y'all doing?
I'm doing well. How are you?
I'm doing good.
Good. Well, what do we want to talk about today, gentlemen?
Uh, capital gains distributions.
What a topic.
Yeah.
The
So,
excitement that keeps on giving all year round, right? Since we're talking Christmas time.
yeah, well, this is something that we can be prepared for come Christmas time. And I say that because typically capital gains distributions are paid out toward the end of the year. Sometimes they do mid-year distributions, but let's take a step back and Greg, help me out. What is a capital gains distribution?
Capital gain distribution within a mutual fund, when the manager decides to buy and sell the securities underneath of the mutual fund, there are capital gains or capital losses. And the mutual fund itself decides how much they want to distribute out to the shareholders. Whether, like you said, whether it's mid-year or definitely by the end of the year. And it's something that the client themselves cannot control other than selling the mutual fund. So they don't have a say in what the capital gain or loss distribution will actually flow through.
Okay, so there's a mutual fund that invests in different stocks, say, and they bought a stock at a certain price, and then they're selling it at another price. Hopefully, it's going to be higher, right? So you have a gain.
Right?
So inside of the mutual fund, they're going to buy a stock, and then when they go to sell it and it's at a gain, then that gain is distributed to investors of the mutual fund.
Mm-hmm.
Correct.
And it doesn't matter how long that you've held that mutual fund. If you've held that mutual fund as of the date of the capital gains distribution date of record, then you're going to receive this capital gains distribution.
Right.
Correct.
So that sounds like a good thing, but I think maybe it might not be such a good thing that you're getting this gain distribution, because when they pay the distribution out, the share price of the mutual fund is actually reduced by the amount of the distribution. So if you have you made this investment and you've received this distribution, but now your investment is worth less because this distribution is made. If it's reinvested, you have the same amount of value. You just have more shares that are a little bit less value. So, but your total investment is the same, but there's a tax consequence
Right.
of that
I
capital
have a
gains
suggestion.
distribution.
Why don't we give an example? Skylar, walk through that same scenario, but the mutual fund is worth $10.
All right, so I have a mutual fund that's worth $10, and and then the capital gains distribution is worth 10%. So now you have $1 being distributed out of that mutual fund. So now instead of the share price being worth $10, your share price is now worth $9.
Right.
And if you have your reinvestment going in, your value of your total investment is still going to be $10. If you have it paid to cash, now you have a $9 investment and $1 of cash.
Mhm.
And that $1 of cash that is paid out is now subject to capital gains taxes, either short term or long term, depending on the gain that was inside of there. So now it's like I put $10 in and now I have $10, but now I owe tax
Yeah,
on
the one.
one of those dollars, and that is regardless of how long I've held that investment.
Right.
Right.
And so obviously you scale that up from $10 to $1 million or 10 million, whatever it is, dollar amount. It's
Yeah, so
chunk of
so
change.
yeah, so and mutual funds are great because you don't have to uh with no matter how much money that you could get redemptions from the mutual fund company, so you have a great amount of liquidity. You also get to purchase a diversified portfolio of investments inside of that mutual fund, and it's professionally managed. So there's lots of positives of mutual funds, from diversification, active management. One of the downsides is these capital gains distributions. So if you
Right.
hold mutual funds outside of a tax advantaged investment account, such as an IRA or a Roth IRA or a 401k, for example, you're not going to pay tax on those because there's tax advantages to those types of accounts. But if you just have a regular brokerage account, you're going to end up paying tax on this capital gains distribution.
So what's the alternative? What do we
So-
advise clients if they don't want to pay, if they specifically don't want to pay this, capital gains tax?
Well, there isn't sort of an end all be all for, hey, you have to avoid capital gains distributions at all. But an alternative to mutual funds would be exchange traded funds, where sometimes, and depending on the fund itself, there might be an identical version of that mutual fund in ETF format. An exchange traded fund, they actually don't buy and sell the underlying investments, but they have what they call is creation units. And when these units are made and they are exchanging in and out of them to keep the correct investment mix in the exchange traded fund, they just inherently don't have the capital gain. And so there's additional tax efficiency. So exchange traded funds could be an alternative to a mutual fund to avoid taxes on capital gains distributions, which could be helpful for your tax bill.
So would it be fair to say exchange traded funds, the shareholder, the client retains the ability to decide when to sell and when to hold, hence when they pay or subject to capital gains and when they're not, versus a mutual fund, you lose that control and it's based on whatever the mutual fund manager / mutual fund company decides.
That's correct. So if you're going to hold an exchange traded fund, if you buy it, you're not going to pay tax on a capital gain until you have a gain and it's sold.
Right.
So,
So ironically, mutual funds have more active management within the fund, obviously, versus an ETF, more passive, right? But as an investor or an advisor on your behalf, you may want to be more active at looking at the ETFs and managing what ETFs you're in, and looking at capital gains on the buy sell kind of side versus. I just think it's ironic, right? You're more active on what you're purchasing and selling on the ETF side, but the management within the funds much more active on the mutual fund side.
that historically has been true, but there's actually been newer active managed ETFs that have come to market and that are available for investors now. So, but even with the passive investment strategy of the ETF, there's still changes.
Right.
And I mean, you could have a passive mutual fund that just invests in an index like the S&P 500. In the mutual fund format, the mutual fund manager is going to try and track that S&P 500 index, which changes over time based on the market weighting of the underlying investments. The S&P 500 is always the S&P 500, but the 500 companies inside of it change over time.
Right. Right.
So there is fluctuation of the underlying portfolio, even in a passive investment. However, the taxation of it is a little bit different. But the active ETFs is something that is newer, where you can get active management now within the ETF. So sort of a reason to go for the mutual fund, like you were saying, is, hey, they tend to have more active management opportunities or investment options than ETFs have. So if you wanted to be passive, it would be ETF. If you wanted to be active, mutual fund. But that's no longer the case. So there's actually a good active there are some good active options in the ETF format that are also more tax efficient relative to mutual funds.
Good. All good info. Work with your advisor, work with us if you're curious about more differences in them.
Right. Allow us to help pro-con the different options, because the more options, the better. At least that's how I like to look at it.
Yeah.
So.
All right.
All right.
Well,
Well,
thank
enjoy
you
your
guys.
weekend.
Have a good weekend.
Have a great
All
day,
right.
guys.